Hey, good afternoon. Well, we got 2 chapters left in this semester, and wanted to post a short video on chapter 13, which covers the accounting, the nuts and bolts for these not-for-profit organizations. In the Blackboard, besides the PowerPoint file, you also find some notes I posted with highlights from the reading, the chapter reading. Be sure and download those and take a look at them because there's some I think some salient points there that I want to bring out in terms of what's the financial reporting package, what's different in the balance sheet, the income statement, and cash flow statement. The cash flow statement is actually very similar to the one you learned how to do in financial accounting and intermediate accounting, with just some unique things like donated and charitable contributions thrown in there. Okay, and so let's see here. I need to get over to the slides. All right, and so there's some criteria in the beginning there that talks about how do we tell not-for-profits from governments. And there's a couple key points there that, excuse me, you want to be familiar with. GAAP is the standard for, or the FASB is the standard for all the financial statements for not-for-profits, as opposed to GASB. So there's, and also not-for-profits, you can have restricted assets and temporarily restricted assets, and so you want to be familiar with those and basically that net position. So yeah, unrestricted, temporarily, and permanently restricted, and so the income statement is also kind of unique, and that's in the supplement that I posted. And the big thing I just want to say quickly about that is you'll see that in the top half, the revenue half, you've got restricted revenues. And if you have restricted assets, you can't spend those, but sometimes you can spend the earnings on those. So you get assets that are contributed, you would count them as a revenue at the time of the contribution. And then earnings will show up as temporary restricted if they are restricted for some purpose or time period. But in a lot of the journal entries we're going to see in the problems, it's really moving these restricted assets and temporarily restricted assets over to unrestricted, or showing that you met the restrictions. And then the bottom of the half of the income statement is all the expenses show up in the unrestricted, and that's the assumption that you're only going to have or expenditures related to activities that either meet restrictions, so they've been released. Released is the term they use, or they weren't restricted in the first place. And so some of the other things that are unique here, let's go ahead and roll on through here. And again, they kind of show absence of ownership interests. They don't have political appointees. One of the problems in governance in this area, and we'll see more in the next chapter where we talk about formation and regulations, is that the IRS is the primary regulator, and their powers are, they can impose penalties, they can take away tax-exempt status, which is like a death blow, but their emphasis is on providing information so that donors and sponsors know how the money is spent. And that's the biggest kind of stick they have. So if people are paying attention to what the agencies are spending their money on, how they're managing the contributions, they'll lose those if they're mismanaged. Okay, and so again, there's some guidance here on. So FASB, I already said that. All right, let's keep going here. The objectives here again are to make resource and allocation decisions. So you've got 2 big sets of users here. One is there are creditors. There are really no stakeholders other than just people that support the organization, and I mean they have stakeholders, but they're not shareholders. There's no equity interest, but they do get contributions, and so there's a lot of non-exchange transactions that are voluntary, and that's the emphasis here in financial reporting is providing information to those users, so that those stakeholders, so they can see how their money is spent. The basic financial reporting requires accrual basis. statement of financial position or balance sheet, statement of activities, income statement, statement of cash flows. And again, it can be direct or indirect method, operations, financing, investing. All right, and we're just going to flip through these. You can read those and talk about them. Statement of activities. And they talk about here this column to use, four-column format. All right, this four-column format. And again, look at that pages that I posted and you have in your textbook, and see how the funds actually flow across and from the restricted, temporary restricted to unrestricted using these restrictions met for the resources. And that's what they're talking about here, these reclassifications and cash flows. And some of I highlight the reading I posted highlights some of the unique transactions, donations, and contributions that you would get. And so one of the things that's kind of unique to not-for-profits is that you do get contributions of time. And there's a couple of rules that are brought out in the authoritative discussion of how you recognize those. Anything that's tangible, equipment, things that can be, they're equipment or materials that are turned into tangible assets, are going to be counted as contributions of the market value. Services are only counted as contributions and recorded as revenues when they are unique, like attorney, accountant, computer programmer, nurse, things like that. And you are going to have to incur them anyway. If they're just kind of basic time that people contribute, we don't. We might track those, but we don't recognize them as formalized contributions. There's functional expenses. This is a big thing for not-for-profits, and the thing to be aware of here is that notice the categories here. We've got supporting and program activities, and that's a big difference from financial reporting. And people that contribute money, they want to see most of the funds go to program activities, and as little as possible to support fundraising and administration. And some of the ratios, performance measures that we'll look at really look at those ratios. There's in the supplemental reading I posted, there's an example of these functional expenses. And this is, you take the natural classification or object codes that we're used to seeing, wage expense, rent, insurance, so forth, and they're recast into functional areas. And so like there's an example, I think, from American Cancer Society, and shows how those expenses are recast. And those are required for health and welfare. So if you run a not-for-profit clinic or a behavioral health, counseling, any of those things. All right, then you got your notes of financial statements. And then we just go through here and talk about these different types of revenues. So we get conditional and unconditional, unconditional and conditional pledges or contributions. So you can get contributions that are restricted as to time, or permanently restricted, or totally available to whatever. Pledges, when you go to, in fact, we just had an event this week, School of Management hosted Business Leader of the Year. One of the activities there was to solicit pledges for the school, either scholarship or unrestricted funds. And you'll see there's some special rules in how we account for those. If they're conditional, then you have to honor those conditions. And if it's triggered by an event, like there's a multiple choice problem that it's in the chapter, and it talks about, well, somebody gave a large pledge, but it was contingent on them getting funding to complete to build a building. If they were unsuccessful in getting that funding or the amount, the pledge could expire or would never be recognized. Okay, and they talk about in-kind and contributed services. As we talk about, it's got to be if it's time, it's got to be specialized skills. Anything that's donated is recorded at the fair market value when it's donated. Okay, special events. A lot of not-for-profits host special events. And the accounting for these things is a little bit tricky. You have to review those requirements, but in essence, the goal here is you don't want to put everything into program related, because that tends to understate the admin and fundraising activities. So, and you can see donors and contributors are really sensitive to the level of funding for support activities like management and fundraising activities. And so the default is you've got to have certain requirements met in order to count any of that as program-related direct expenses. And then they talk about these intermediaries, and so like a good example of the intermediate is United Way. And the issue here is, when do you recognize revenue? When intermediary that meets certain requirements, if all they are is a conduit, they won't recognize the revenue. It just passes through to them. If they have variance or have the ability to influence the contribution allocation of contributions, then they would tend to recognize it as revenue at that level and then pass it down. Okay. Oh, come on. Functional expenses. There's a lot of slides here. We're not going to go through all of them by no means. All right, and again, so these are some of the examples of functional type expenses: research, information, advocacy. They're program related, and then the support. So when you do fundraising costs, sometimes you have an event, like I said, that you're doing. It's partly programmatic. So like breast cancer awareness, they'll do like community events where they do free screening, and concurrent with that activity, oftentimes they'll also have information about the organization and encourage contributions, financial contributions. So when you have those, it's called, you've got a joint cost, because there's part of it's fundraising, part of it's programmatic, and there's specific rules about how you're going to, if you can recognize any of that as programmatic. So there has to be a purpose and audience and content criteria that has to be met. And again, the problems in the chapter do a nice job of breaking this out. But like, for example, if you have people go door to door in a neighborhood and they talk about the organization and what it does in the community, if you're picking the neighborhood because it's affluent, then that audience is really being, that neighborhood is being picked not because of the programmatic purpose, but mainly for a fundraising purpose. And so then it becomes, well, this is really a fundraising activity, even if you do have genuine, bona fide programmatic activity. Restricted assets, so those would be ones that are not available for operating purposes because the donor has imposed those, and we have to honor these things. Collections, sometimes you have art, you can have art collections or other valuable things. And so these are recognized as assets and cannot be, but typically they're not depreciated if they're maintained and don't wear out. And then there's a lot of bunch of examples that are illustrated and discussed in the chapter, so I'm not going to go through those. The main thing I want you to look at is pull up the excerpts that I posted and review the highlights that I have there.